Hi, this is Robyn. I'm one of the Fin module leaders, and today I'm going to take you through a short video about temporary differences and how they're accounted for under IAS 12 income taxes. It's an area that people often struggle with when they're tackling tax effect accounting, so an example today might help you to solve some problems around this topic. Today's topic is, so why are they temporary differences? I think people struggle to understand sometimes why they are in fact temporary, and an example should help. So one aspect of what we'll look at today is trying to work out, where do temporary differences fit? How do they tie in with the current tax liability calculation? How do we calculate a temporary difference? And the journal entry that records the current year movement. We'll also look at getting the temporary difference into the right account, the deferred tax asset or the deferred tax liability, and recording the temporary difference into this correct account, depending on what type of temporary difference we're dealing with. And we'll look at how the temporary difference can reverse from the account that they have been recorded to. So let's look at the facts in my example for today. So I've got a machine. Its cost is $21,000 and it was acquired on the 1st of July 20x0. And there's a tax rate of 30%. For accounting purposes, we've decided that the life of the asset is 7 years and it will be depreciated on a straight line basis over that time frame. So there's annual accounting depreciation of $3,000. For tax purposes, let's just assume that the life is 3 years and again, straight line depreciation. So the asset will have tax depreciation of $7,000 being deducted each year. So it's really common that temporary differences can arise with depreciable assets because of this differing time frame over which they're depreciated. When you're trying to work out if there's a temporary difference, it's really important to go for the gut feel. So here the asset has got the same cost of $21,000, just the time frame is different. So will it give rise to a deferred tax asset or a deferred tax liability? I like to think about using a gut feel and just saying, okay, what's happening for tax purposes? Here we're getting the tax deductions more quickly. So to me, I think if I pay less tax today, at some stage you're going to have to make up for that. So less tax today means more tax to be paid tomorrow. So we've got a deferred tax liability, because we're getting the tax deductions more quickly. And you can see that with $7,000 in tax deductions versus $3,000 in accounting depreciation expense. So we'll look at where this fits into the formula that you've got in your CSG, but it's a good cross-check to think about using this sort of gut feel. More or less tax today when this temporary difference first starts to be created. To help understand why this is a temporary difference for our machine, I've plotted this out sort of on a bit of a timeline so that you can understand that over that sort of 7-year period, what we've got is $3,000 per annum for accounting, but we've been depreciating it over a 3-year period at $7,000 per annum. So apart from my rather dodgy looking bell curve there, what I'm trying to show you there is that yes, this is a temporary difference. In the first 3 years, I'm going to be recognising a deferred tax liability by crediting the DTL account. It's rising up to the end of year 3 because the value of my tax depreciation deductions have been greater than the accounting that I'll be expensing over that 3-year time frame. But in the last 4 years of the asset's life, that DTL will be reversing, because by the end of year 3, I will have run out of tax deductions. So that you can see that the temporary difference is fully reversed by 30 June X7, because $21,000 has been expensed for accounting purposes and $21,000 has been deducted for tax purposes. It's just that they're hitting our different books over those different time frames. 3 years for tax, but 7 years for accounting purposes. That's the end of part 1 of this series of videos. In parts 2 to 4, I'll take you through what happens when the temporary difference increases. Part 3 will take you through what happens as the temporary difference is reversing. And finally, in part 4, I'll show you how you do the accounting when the machine is sold. So I hope you'll join me in these later videos.